You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. This week on The Biz, the Life Insurance Income Series 3, the tax items. And on today's show, tax exemptions, deductions, and credits with national financial columnist and CPA, Ken Davis.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. We're broadcasting live to a nationwide audience of financial planners and advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And with me today to tread lightly on the tax code, Ken Davis. Hey, Ken.
Hey, Stephen. Good to see you again.
Most of you have seen Ken on my show. He's our resident guru, CLU, CHFC, CFP, and of course, CPA. And we're talking about life insurance income and says, Steve, you already did 2 weeks of income series. Eric and I just really went to the wall on this, on fees, expenses, loan provisions. If you didn't see it, you need to go back out there. That was to die for. But today, what we're doing today is we're going to manage a little different, because one of the gripes that I always hear are the people who sell ERISA plans, specifically employee plans, 401ks. And before we can talk intelligently, all this week we're going to really unpack this for domestic as well as business use. I want Ken to kind of walk us through some basic ideas. And I have to say, Ken was on last week on our Social Security thing, and man, there were so many things I didn't know about that. I was surprised. I have to say, I was taken to school. I went back out to the woodshed and got a learning, I have to say. But let's just go into this now, because my wife is already thinking about doing my spousal Social Security after last week's show.
Yeah.
People are teeing off. You know, I'm thinking that divorce show, that show is hot. Well, let's get into it today. Ken, I want to talk about some of the basics: tax exemptions, tax deductions, tax credits, and I want to manage it because they're not the same. They deliver different issues. It messes with AGI. It messes with your magi, or do you call it magic?
Magic.
I don't know. As we get closer to Christmas, I'm going to switch over and call it magi. Your what is it? Modified gross.
Modified adjusted gross income confiscation. That's where the magic comes from.
Confiscation.
They use magi, and we add the C because they grab more and more of our money by playing with the formulas.
Well, listen, we're getting pretty close to the elections here, and it's all going to come down to it. And we'll do the moment we know who's the player, we will do a post show, because Ken will be on for our end of the year show in December, as well as our charitable giving a week. That whole week, we're going to do it towards the December. You won't want to miss that. Last year, that was a hot show. I want you to be totally up to snuff, because by then we're going to kind of know where the games are going to be played and where we're going to be at. And oh my gosh, is the stock market already taking into account a higher capital gain? Well, that's not today's show. I'm so sorry. I wish it was newsworthy. We could do it. Ken, talk about tax exemptions and phase outs on this, because I think everybody thinks, well, I get my normal tax exemption, my wife, myself, my children. But if you make a certain amount of money, that could be phased out. So talk about the people who get it, the phase out. If you know, just talk a little bit about it, bring us up to speed on those issues.
Well, you know, let's talk about exemptions and deductions and credits a little bit. An exemption and a deduction, you know, let's say I had a $1,000 deduction or a $1,000 exemption. Well, that doesn't save you $1,000 in taxes. It just reduces your taxable income by $1,000, okay? So if a person is in a 25% tax bracket, then they save $250 in taxes. The $1,000 times the tax rate of 25 gives you $250, okay? And then a credit is what we call a dollar for dollar reduction in taxation. So if I get $1 of credit, then I save $1 in taxes. So I'll take $1 of credit over $1 deduction.
So credits are superior.
Right. The other thing that's interesting about credits is that they actually benefit people that make less money and are in lower tax brackets, because you know, a person paying close to 40% in taxes, $1,000 saves them $400. Okay, but a person who's in a 15% bracket, $1,000 deduction only saves them $150. So you know, if people are looking for some sort of equity in the tax system and trying to benefit lower earnings kinds of people, a credit is actually a much better concept. And you know, part of what we're talking about today is how, you know, the government has realized they can't, increase tax rates, but they can play around with exemptions and credits and deductions, and they can say, if you hit a certain adjusted gross income, we'll phase out certain items. Or contributions to IRAs are based on adjusted gross income, or alternative minimum tax starts with AGI, or taxation of Social Security. So there's all these mechanics going on in the background, and it's gotten so you really can't figure out what the effect's going to be until you run it through a piece of software. And that's really where I object, is we really need a more transparent code. We need people to know what's happening. We need to know the government is actually increasing taxes, not through tax rates, but by phasing out exemptions, deductions, credits, or having special formulas.
Well, we're trying to look at all the options so we can find out what's the best real cash flow, the net I can take home pay, what's in my actual hand after I pay all my expenses in whatever plan I'm in, or all my fees, costs in the policy, costs in the plan. I want to know everything all in and then crunch the numbers. Now, one of the things that you and I really appreciated, we were really remarking a couple weeks back about an article put out by one of our good bloggers out on the web, where he actually really brought to table and reminded us, hey, employee contributions, 401ks,
right,
and any of those guys that fall in that ERISA are paying the full boat on Social Security and on their Medicare taxes. Now, Ken, I got to tell you, I kind of remembered that, but I kind of forgot it. Now it's so much in the forefront of my thinking now, because I think people were thinking, oh, I'm getting a reduced Social Security. I'm getting a reduced Medicare. The only thing we're doing is the federal tax is getting reduced. Now, I think the state too, probably, right?
Yeah.
Yeah. So,
well,
but
it
not
depends upon
those.
the state they're in.
Exactly. So what I'm saying, I guess, is now we're looking at real numbers to compare. So we're only talking about the actual deduction, the federal deduction, and comparing it, and what brackets does it really make sense in. I mean, that to me where it's at. When we come back from the break, we're going to address some of the policy loan options that will deliver somewhat what I call tax deduction equivalents. And remember, you can hop out to IULUniversity.com for the best training, education, and sales support when it comes to life insurance as a retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Have you been holding back on submitting your impaired risk case? Now's the time to dig them out of your files in the commission graveyard. Underwriters can be more like undertakers, sleep at the wheel of their hearse and driving your case into a ditch. But at Brokers Alliance, our triage field underwriting team drives your case to our special ICU unit. And because we're driving your case and not the underwriter, we can steer your impaired risk case to the carrier with the expertise specific to your client's impairment. We've separated the underwriters from the undertakers. We know how to breathe life back into your impaired risk case. Diseases don't have to be deal killers. They can be sales opportunities. And don't forget to download the copy of the Impaired Risk Field Guide, the most comprehensive impaired risk report in the industry. Go to www.impairedriskreport.com.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Ken Davis. And remember, you can order today's giveaways at thebiz at brokersalliance.com. We're going to give away, of course, our 1040 overlay, the marginal tax brackets for 2012, and we're giving away our solar kit, our self-owner life and retirement plan, which Ken and I are going to be talking about on the Thursday show. That kit is really great. It's a really great piece put out by one of our carriers, and I think you're going to really appreciate it. And just a heads up, before moving forward with any of the ideas that you hear on this show, especially this whole week again, can always consult your tax advisor and your broker-dealer compliance department, because we're just talking about taxes, we're not giving advice. And in this segment, we're talking about can we use policy loans in a contract as an option to deliver a tax deduction equivalent, or am I reimbursing it? Now, the reason I bring this up is because most of the contracts that we deal with, we're not going to get a deduction because most of the life insurance that's sold are non-qualified plans, so there is no way to deduct this. And so I thought, well, how about a credit? Well, there's no way to get a credit.
Right.
How about an exemption? Well, there's no way to get an exemption. So we're not going to get any of what I call the traditional issues of deduction, exemptions, and credits. So what I wanted to know is, if I wanted to try to get into a par or try to measure it kind of equally with an ERISA federal deduction that you get with a 401k, if I could find a contract, and I found 2 or 3 of them, but one of them is excellent, who will actually let you use the arbitrage loans and pay the taxable event equivalent or reimburse yourself, even though it's not deduction, you're reimbursing yourself. And to me, that was startling that I could do it year one. Now, see, remember, I kind of saw it. You stuck around 5th or 6th year, good contracts. 10th year is really what I want to be. But if I wanted to actually make sure that I got my equivalent, and if I had a good arbitrage on the S&P that year, I might be above the line. My S&P could actually deliver, right, my tax savings, basically.
Well, if you boil it all down to the essence, what we're talking about is cash flow, okay? So instead of couching it in terms of tax deductions or tax equivalencies, what we're really talking about is net invested dollars and cash flow. And so if somebody put in $1,000 into an IRA in a 25% bracket, they get $250 of savings, so their net investment really is $750, yet they have $1,000 working for them, okay? In the case of what you're talking with policy loans, is you're not getting a deduction, but you're borrowing money, that $250 out, so that your net invested is $750. Now in this case, there's only $750 really working in the contract for you because you borrowed some money out. However, in a way it is working for you because you're leaving that full $1,000 in the indexed account and you have a loan account of $250 and you get to make the spread on the interest.
Right, and we hope that if we're above the policy loan cost, anything above that line is going to pay our in your example, our $250 tax bill.
And the bottom line is, is one better than the other? What you do is you look at your net cash that's on an after-tax basis long term, and then you compare it to the results on the ERISA types of or IRA types of things. And it's really, to a certain extent, like a comparison between a Roth IRA and a regular IRA, because our tax savings on the life side comes out at the tail end. So, it's interesting when you actually, this is a very interesting idea that you guys came up with. When you look at it at the end of the period, where do I stand? How well did this do? And then, and this is basic finance 101 in college, is what is my expected rate of return times my expected probability of success? Okay, and with an indexing strategy, we have a high probability of success. In stock and bonds, we may not. We may have more risk, and so you multiply the risk times the gain potential, and then look at your net adjusted, risk-adjusted returns.
Well, when I'm looking at the federal income tax, and again, I'm looking at it for just our filing purposes, right? And when I look at some of the marginal brackets right now, we're actually, this phrase, I see if you approved, Ken, marginal blended tax, because it's marginal, but as we make more money, it's a piece of that bracket and it's a piece of this other bracket. It's kind of a blended bracket.
Well, yeah, and actually I've always used the term effective tax rate because when we add a dollar, whatever tax bracket we're in the marginal tax bracket. So if I'm in a 39.6 tax bracket, 39.6 cents is taxed. But when I take that and add it to all the other taxes for the first, $20, $50, $100,000, then it is a blended rate, and that becomes my effective rate. That is my total taxes divided by my total taxable income.
If you think that, if you're looking at the second tier of marginal brackets, married now, I'm talking married, and I'm looking at somewhere around 69,000 as your top out rate, that means that I have two brackets in there that got blended. So I'm blending actually a 10% and a 15% tax bracket. And the reason I bring this up is because most of the people that are contributing to 401ks are middle Americans. And those middle Americans are in these brackets. They're not in these high 25, 30 brackets. They're in the highest maybe 20, but most of them are in the teens. So if I'm putting away maybe $1,000 in your example, I might be saving at the most maybe $200, $220. So I'm looking at that as, should I take the deduction and take my $220 and run in trading later on that my policy loans will come out free, and that will not be used as a calculation for the provisional income test for Social Security?
Right. It's a really good point. So you're pointing at middle America actually benefits more from deferral than from the deduction.
If you can't, like you said in the credit, if you don't have any credit, if you don't have taxes, you don't have a credit. That's the whole point. Remember, you can watch this show and all our shows by clicking the red on-demand video button right on our homepage at brokersalliance.com. Well, that's the buzz on the biz for today. You've been in the zone, the business insurance zone.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.